12 days ago, one of our members, Caleb, came to me and said, "Hey, Don, can you show me what it means to write or sell a covered call? Can you show me," his questions were specific, "can you show me how I can find the best covered calls to write? Can you show me what it will look like? And can you share with me how I might manage it?" And we did just that. And we did 3 covered calls. And we did a covered call on Amazon, on Gold, and on Google. Good afternoon. I'm Bag of Don at StockMarketCaddy.com. Today is Sunday, November 13th at 12:15. Now, this is not a recommendation to buy or sell anything. And for Caleb, we were not recommending that he buy or sell anything or even do a covered call. But we wanted to answer that question, and we're going to show you in the next few minutes how we went about choosing the stock that we did and how we went about structuring the covered call, what we paid for it, or what it paid us actually, and what's happened over the last 12 days and how Caleb might manage it, how you might manage it. We are mentors. We are teaching folks how we trade the markets, how we use the tools that we have built, and of course we make these tools available for our annual members on their desktop, and for our monthly members, these tools are available to see through a video that we do each and every night. So let's get started. So the first thing that one needs to do, and we're talking about a generic covered call, and then we will answer those other questions, is to choose a stock that you would like to own maybe. And ideally, this stock is in a flat trend to an uptrend. And what one is going to do is buy the stock at a specific price here, and they're going to buy at least 100 shares, and then they are going to go out or up from where they bought it, and they're going to sell a covered call at a strike price higher than what they bought the stock for. So as an example, let's say the price is $100. They buy 100 shares at $100, $10,000. They go up in the price, and how far up we can show you what we did. But let's say it's at 105, and they sell the call, and they are paid money, and they receive a credit, and ideally you're selling the call out about 45 days. Now, what can happen? And by the way, selling covered calls is fairly conservative. It's one of the few things that the government will allow you to do inside of an IRA account. Now, when you buy the shares, the stock could go down. And if it did, you'd be losing money on that position. It doesn't remove you from having a drawdown necessarily. Let's just talk about owning the shares, right? So if you buy it right here, whatever that price is, and we're using as an example 100, that is your cost basis. Now, for Caleb, or for you, for anyone that sells a call at 105, and let's say they receive a credit of $3, one way of looking at that $3, and it's out 45 days, is that it might be looked at as lowering one's cost basis. If you receive a $3 credit, your cost basis would no longer be 100, it would be 97. So you might think of receiving that credit as insurance on your core position should the stock go down for a little bit. What happens though is this, and it's important to understand this. When you buy the stock over the next 45 days, the brokerage is going to report on whatever happens with that stock. And in this example, let's say that it goes to the moon. They will continue to report all your profits on that core position. But if you sell a covered call at 105, they will also show that call that you sold against that position, and they will continue to report on what that call is doing to your account. And graphically, what it's doing is it is a short position. Let's get the right arrow from here up. So as you're going to see in a few minutes, Caleb's calls actually worked out very well. They're doing exactly that he had planned out. He had a strike price. He profits from here to here. That's the maximum profit his position can make over the next 45 days. 100 to 105. Plus, he gets to keep the $3 the person paid him for buying the call that he sold. And that, in essence, is also looking at it that it could have been, lowering his cost basis. But if the stock goes to the moon, or the ETF, whatever it is, yes, his core position will be showing up in his brokerage as making money, but the call obligation will, in essence, cut off his profits right here because it will be a negative. You do not, at least we don't, and we suggested in general that Caleb or anyone, if you map out buying the shares and selling a call for 45 days, if it gets above your strike, we do not suggest that a person come in and pay more money for the call to close out the call so to then participate on that. We wouldn't do that. What will happen is there's three things that can happen. And it's actually a beautiful thing. If in 45 days after selling the call, he is below the strike price of 105, he will still own the shares at whatever price it is, and he will keep the person's $3. If at expiration the stock or ETF is above the strike price, the day after expiration, his shares will have been called away. Not his money, not his value, not his account value, but the shares. And he will see cash in his account. The option will have also expired and gone away. The account value will reflect the profit from where he bought it to the strike price plus the premium. So another way of looking at it is, if they do get called away, it would be like selling it not at 105, but at 108, because he was paid a premium. And yes, in an instance where the stock runs way up, he may have left a lot of money on the table. From our point of view, that's just fine. Buying a stock and then selling a covered call against it out 45 days. I simply want, ideally, the stock to run and run and run, and the shares to be called away from me, and I keep that profit and that premium, and I can always turn around and do it again. It teaches the initial person or the new person patience and discipline to sit on the stock that they bought and not to get overly active at all. It is not an active trading strategy. Now, if over the time of the 45 days. If the price does go, whatever it is he bought was to go down, you do get some insurance from the premium that was paid. That's the way you might look at it. But the option will also go down in value as the price goes down and as the time decays, if in that instance. See, when you sell an option, time is on your side. When you buy an option, it isn't. Time is working against you. But in this instance, Caleb would have sold the option. So we told Caleb, and we share with you today, that if you do sell the call at the time you buy it, and time decays and it doesn't move very far, and you can buy back to close the call option, you can do this. If you can receive 90% of the premium, that is, if they paid you $3 for the call, and 40 days later, or 35 days later, you can buy back that call for pennies on the dollar, sure, you could go ahead and do that and do what? Sell another call out another 45 days and just repeat it. The easiest way to learn this is, number one, read up on it, watch some more videos. There's a ton of stuff online. And to do one in a simulated environment, it's going to take you 45 days to see how it plays out, how your brokerage accounts for it. You want to understand this because you don't want to be in a panic situation seeing the negative on the call, which really isn't a negative to your account because it's basically they're hedged. Now, the other question is that you're going to have is, how do I know, and it's a very important one, what stock do I choose? And what strike do I choose? And how far out should I go as we map this out? So let me show you what we did. This is SMC Swing Machine Plus. 12 days ago, the market was selling off. So what we did was come to this tool with Caleb, and we sorted, and there's no stocks in panic. But back 12 days ago, there was a ton of stock in ETFs in the panic column. What we know is statistically, when you have something in panic or in euphoria, the likelihood that we're going to move back toward the mean here or back this way is about 95%. So when we have stock or ETFs in the panic column on our tool, SMC Swing Machine Plus, we want to do what? We want to buy the shares, minimum. We want to buy them there. We might want to fade them or short them over here. But in this instance, we were buying 100 shares of Amazon, we bought 100 shares of Google, and we bought 100 shares of GLD. I'm going to show you that in a moment. But we wanted to do a covered call, and we wanted to do it at the time we bought it. In time, as you get good with writing covered calls, you can buy the shares here, and when the stock runs, hopefully, up into euphoria, selling the covered call in euphoria, you squeeze out even extra premium, and it acts as an insurance policy when the stock inevitably pulls back. So this is where we find them, and we can use this tool and the midpoint or the euphoria point to help guide us as to where the strike price we should sell. Let's go to the examples that we did with Caleb. Okay, now I had opened the Amazon, and Amazon I forgot. We actually did a credit put, which is entirely something different, which is not going to be the focus of this video. But we did gold. And what we did, I'm going to break this apart And right now, this is it here. It was the way TradeStation reports on this. It was a covered married stock, a covered call against, or we married it to the stock, a covered call, or they call it writing a covered call. I'm going to reset this position, and so you can see what we did. Now we did this for 12 days ago. We bought 100 shares of GLD, and the price was, we can deduce this, the whole trade cost was 15,556 or 155.56. That was our cost basis, and that's where GLD was trading. And we can actually click on GLD so you can see where it's trading now. Now, at the time, GLD was in panic. He thought, I thought, and our systems tell us that the likelihood is over the next 20 to 30 days, GLD was going to run to about 165. We're at 165 now, which is a beautiful thing. And TradeStation is reporting that we are up $865, and that is correct. But we bought the stock at 155. We sold a call. We could have gone higher, but we chose to play it conservative. We sold a call at 158. And that's what this is right here. We sold one call for December 16th at 158. And it's a short position technically, and that's why it's red. It shows us there's only 33 days left. Here are some of the Greeks, which we're not going to address now. And Caleb received a credit of $267 right here. When you put these two things together, these two, they hedge each other. So in this instance, it says your maximum loss in owning the shares is that GLD goes to zero. Not likely, but that would be your maximum loss. Your maximum profit when you own the shares is infinity. When you sell a naked call, which we didn't do, was not naked, but if we had sold a naked call, we would have received $267, but our risk would have been infinity. Would have been very risky. But we didn't sell a naked call. What we sold was a call, but against our stock position. And I'm going to put them on top of each other in a moment. But before I do, I want to show you how TradeStation is accounting for this and how pretty much your brokerage will account for it too. For the time that this married call, stock and call are put together, your brokerage will continue to report their perceived profit and loss on the core position, and then they will also do so on the GLD. When you are above the strike price, it's going to look to be a negative, but you need to understand they're hedging each other. So you're up 865, yes, because gold went to 164. But you're down 533 because you did sell the call at 158, and the person who bought the call is doing well, but you're not getting those profits. But that's okay because we planned it that way. We're happy to do what? We took this call, we drop it on top of the core position, and it told us what we had constructed up here, buying the shares at 155, selling the call at 158, receiving that premium, helping us to weather a storm if we had any bit of a drawdown. But our maximum profit from here to here, plus keeping the 267, our maximum profit would be $511. So when we broke it apart, you could see this was up, this was up 800, but this was down. This puts them together, and our profit to date is $332, which is about 60% of our max profit. We still have 33 days to go. GLD is well above the strike price, and I would not close it. There's no reason to close it. It's in my view, I would handle it this way. It's money good. I would just let it run its course and look for everything to expire, hopefully above that strike. The shares will go away, the option will go away, and we will have the amount of money that we paid plus $511. A beautiful thing. That is an example of a covered call. I want to look at Google. We did the same thing with Google. We'll break it apart. We did a put spread, credit put spread on Amazon, so we won't look at that one. It's something different. Here on Google, we bought 100 shares at $85. It came off of the panic column. Google has run. Let's look. Here is Google. We bought it at 85 just 12 days ago. Google is now at 96. So that core position is 1,100. Now you might say, well, I shouldn't have sold the call, but we didn't know what it was going to do necessarily, and we may have needed that insurance. So we went up off of our tool on Swing Machine and picked a comfortable strike price at 87. Fairly close, and we sold a call and we received 340. So same thing, we are now above the strike price of 87. So we bought the shares at 85, sold the call at 87, received a premium. The stock is now above that. Money good. We put the two together. His maximum profit was going to be $531. And he's 346 in. He's still got another 33 days. Just leave it alone. In this example, you're using approximately $23,000, but on a covered call basis, and a fairly conservative approach in doing it this way, and stands to pick up about $1,000 in a month. Just an example. If you have any questions, feel free to any questions about what we did here, but more importantly, if you have questions about Stock Market Caddy, what we're about. We're trying to teach folks how we go about trading, being diversified in what we trade. We trade futures intraday, we trade options and define our risk going out further. Yes, we buy stock, we sell covered calls against it, we short stock, sell covered puts against it. We write or buy credit spreads. Excuse me. We buy debit spreads, both on the long and short side, and we also sell credit spreads as well. And we use our proprietary tools to get the best entries. And we're trading as a business. In the end, folks, we say this all the time, whether it's Amazon, gold, or Google, or Bitcoin, the most valuable commodity of all is time. We can't be buying it, we can't be selling it. So if you're getting it done, and you're subscribing to whatever you're subscribing to, and reading whatever you're reading, and you're getting it done, keep doing it. But if you're not, maybe you want to stop wasting time. Give us a shout. Happy to talk with you. Visit stockmarketcaddy.com. And Caleb, thanks for asking us about covered call writing. It's a beautiful way to go, and it's just one more armament in a person's approach to trading. We want to be diversified in our ability to trade different products at different times. We wish everyone the best, including Caleb. Thanks.